Welcome to the fifth video in the How to Pay Off Your Mortgage Faster series. In this video, we're going to talk about how you can use a revolving credit mortgage account to pay off your home loan faster and save thousands of dollars on interest repayments. So what is a revolving credit mortgage? Think of it as a portion of your total home loan that gets converted into a large overdraft facility. Within this facility, your income goes in and your bills get paid from it. There's basically an everyday account and a home loan account and an overdraft all in one. Let me explain with an example. Using a $600,000 home loan scenario, let's take a portion of that, say $100,000, and let's make that into a revolving credit mortgage. So on day one, on the revolving credit, you owe the bank $100,000. Now your salary comes in. Let's just say $10,000. So now you owe the bank $90,000, not $100,000. Interest gets calculated daily but charged monthly. So let's just say no other expenses happen on day one. You are going to be charged interest on $90,000, not the $100,000. The $100,000 is a credit limit now, or the overdraft limit. You can spend back down to $100,000. You're obviously going to have expenses in the month, so that balance is going to head towards the $100K. Now ideally, your income should be greater than your expenses. Say your expenses comes to $8,000 for that month. So by the end of the month, you'll be sitting at negative $98,000. Over that 1 month, you would have saved money on interest, as you're not paying interest on the whole $100,000, just whatever the daily balances are. Speaking of interest, revolving credit facilities get charged at the floating rate. So the name of the game when it comes to revolving credit mortgages is to channel as much money into that account as possible, and also to spend as less as possible as well. The bigger the difference between your income and expenses, the faster your progress will be. And this is where the flexibility comes in. Because a lot of your extra funds are going to be in the revolving credit mortgage, you are essentially putting extra towards your mortgage without manually having to do it like did in strategy 1. If an emergency situation happens, you can draw back down to $100,000. Obviously, it's not ideal, but it's better to have that option than not have that option. Having said that, a lot of discipline is required because people who are not very good at spending will be hovering at the limit, and you do not want to be hovering at the limit for a long period of time while being charged at the floating rate. And because it's charged at the floating rate, the other flexible part is that you can convert that whole account back into a fixed mortgage whenever you want. Now, there's two cool strategies you can implement with the revolving credit mortgage. One is to put your savings in. Yes, you won't be gaining interest on your savings, but the offsetting effect will be much greater, and you can use your savings whenever you want within the revolving credit. You can also use a credit card alongside with your revolving credit account to supercharge your interest savings. With credit cards, you don't usually get charged interest for the first 55 days. So if you put all your expenses into your credit card and you pay your credit card off monthly using your revolving credit account, which means you're holding your income into your revolving credit account for as long as possible, and you're making one payment per month into your credit card. Over time, this all adds up and you'll be making a lot of interest savings.